Ramani, the CMD, joining in on the show right now. Amit, hi, great to have you today on ET Now. Help
Hi.
us understand firstly how demand has been on ground right now, both in India as well as the GCCs, and how much do you think the contribution is going to be from this particular sector in, say, this quarter?
So GCCs and overall demand has been very, very strong. As you are aware that this year was one of the highest years ever in the commercial real estate with almost 80 million square feet of gross leasing happening. Almost 20% of that, 16 million was flex, which contributed to the overall sector. GCCs are clearly leading the charge. It took us almost 20 years to get to about 1,500 GCCs, and now we are adding every quarter about 25 to 30 new GCCs. 100 plus GCCs are being added every year today. From that standpoint, the next few years, I think the GCCs will drive a lot of the flex demand. Prediction is that almost 50 to 60% of the GCC demand is going to be serviced by the flex sector because of flexibility, agility, and obviously, OPEX, CAPEX to OPEX kind of a model. Also, what we see is that the industry, the flex, is going to be almost 3 times its size. It is currently at about roughly 75 to 80 million square feet. Prediction is that by 2030, it'll be 3 times that size. So I think overall, the sector is done well. And GCCs clearly have contributed a large portion to it. At Awfis itself, we have about 10 plus GCCs in the last 9 months that we are servicing. eBay, Meltwater, ABC Fitness, Trinity, many, many others. And the demand for the future pipeline for GCCs also continues to remain very strong.
Amit, how are you placed in particular? I know you spoke about, you give us some color around what you've been doing over the last 9 months or so. But how well are you placed to capture this opportunity? And what's the internal aspiration? Is the internal aspiration to gain a certain market share within this entire space? Because obviously the opportunity is large. How quickly do you ramp up? Do you grow faster than industry? Give us some color on what the aspiration looks like.
So clearly, I think the aspiration would be to be market leader. We have maintained that market leadership position over the last few years, and we will continue to maintain that. Today, we have the largest network in this country. Very proud to say that we have 250 plus centers today in India across 19 cities, the largest network of any player. From a GCC standpoint, we would say we are one of the most formidable players where we are servicing GCCs not just for their space demand. We are also providing IT infrastructure, transportation solutions, food and cafeteria management services, furniture, many, many other aspects to the GCC. So it's a completely integrated solution. With having 10 plus GCCs with us today, which we have, these are first time GCCs. Otherwise, they're obviously a large portion of our demand, almost 50% of our total portfolio today would be servicing GCCs. And from that standpoint, we want to continue to maintain our market leadership position. In H1 of 2026, we have already sold about 30,000 seats. Last year, for the whole year, we had done about 50. So it looks like we will end up around 60 plus thousand seats in this year, which is almost about 20% of the total demand of the country. So yes, obviously, these are the areas that are driving the growth for us. We also set up verticals, right? So we were doing co-working, managed office, today IT services under Office Tech Labs, furniture under Frame, and Office Cafe for food and cafeteria management services are now becoming verticals on their own. So the integrated solution platform, workplace as a service platform that we were envisioned about a couple of years ago is now seeing some traction around all of these areas. We continue to maintain our leadership in co-working and managed office. Design and build, which we started 3 years ago, today contributes 25% of our business. And that will continue to grow. We believe that that area has a huge potential. No brands have been created in this space in this country, just like we were the first ones to do it in this country in the co-working space. We look forward to being the first ones to do that in the design build to create a strong brand in this area.
But Amit, tell me, there's intense competition as well in this sector, right? And especially when it comes to the co-working segment than in managed office spaces. Because co-working, I guess, has a lower entry barrier. How do you differentiate yourself with the others?
So clearly, I think if you really look at the industry, we are the only branded player in the sub 100 seat category, which basically is primarily co-working, right? Because today, if you look at our portfolio, 35% of our business is more than 500 seats. Almost about 40% of our business is more than 200 seats, and about 60% of our business is more than 100 seats. But 40% is also less than 100 seats, where we are now probably the only branded player in that space. You are right, the competition is intense, but today you also have to look at the marketplace where the top 5 players manage almost 60% of the total demand in the country. So the brand holds a very, very strong, view in people's mind, especially when it comes to enterprises. Today, about 65% of our demand is from large enterprises. So it clearly means that even in less than 100 seat category, large corporates are looking at branded players. So from that standpoint, intensity is there, but clearly once you have a strong brand, you can obviously, kind of command your price, and as well as command, the respect of the clients as well.
How's the ramp up playing out, Amit? Give us a piece of that. There has been a bit of a drag. Do you believe that the ramp up is now stronger than what you were penciling in earlier?
No, so clearly, I think we are on track. We basically year on year added about 35,000 seats. If I look at trailing 12 months, we also in H1 added about 14,000 seats. Our pipeline is for 170,000 seats already, which are under LOI, fit out, or advanced stage. So clearly, we have a decent visibility on our seat addition. About 61% of our portfolio continues to be managed aggregation, and that ratio of 65-35 will continue to evolve as we go forward. Premiumization is something that we are focused on. So of all the seat addition that happened, almost 70% happened in grade A plus supply, and about 30% happened in grade A supply. So clearly, from that standpoint, our ratios on managed aggregation, the seat supply, will continue to remain strong. The amount of seats that we have overall blended, we are sitting at about 74% occupancy as of the last quarter. And overall for centers which are more than 12 months, we are sitting at about 84% occupancy. So all those metrics continue to remain strong. And we have been able to maintain the seat addition as well as the occupancy in our company at this stage.
Amit, what happens in case of a down cycle? Currently, we're seeing decent growth. GCCs is supporting that growth. So all the tailwinds are in your favor. But really, the question will be that there will be a point where there will be a down cycle. How do you protect business at that point? I'm trying to get a sense.
See, so from our standpoint, the model is built on, ensuring that, you are able to sustain yourself in any kind of cycle. We were probably one of the largest operators when COVID hit, and we survived, right? And the reason for that is the model that we run, which is managed aggregation, where our landlord becomes our partner. They are a profit share model. So when there is an up cycle, they obviously, have the upside, but in the downside, we kind of manage it. And I think that model is one of the most resilient models. And I hope it's not tested ever. Hope the cycle and the tailwinds continue. But if it was to happen, I can assure you, we'll probably will be the last man standing.
And what about managed versus owned, right? Give us a sense of how the risk gets distributed given the 65-35 ratio that you're targeting. Does that also contribute to your confidence with regard to the risk coming down in case of a down cycle?
Absolutely. 65% of the portfolio is in managed aggregation. In that managed aggregation, essentially, there is no rent, right? So rent, which contributes to 40% of the total revenue of any, co-working operator. In our case, that is minimum guarantee, which is 50% of the rental. So we are almost 50% protected than anybody else in the market, right? So I think that gives us a tremendous support if there is a down cycle. As I said earlier, in COVID, if we did not have this model, we would not be here, right? We were the only operator at that stage that had a scale of any significance, right? And we survived because of that model, and hope it never happens. But if that was to happen, our model is probably one of the only resilient models in the world to be able to survive that.
And what are your margins in those two segments? Amit, of course, I'm not talking Q3 in particular at all. I'm talking in general. How are margins there in each of those segments?
margins in both the portfolios is a bit different. So about 65% of our portfolio is managed aggregation, which is primarily co-working. In that, typically, because we have a partnership with the landlord in a profit share model, the margins are roughly between 24 to 25% at a center level. In case if it's a straight lease, which is the remaining 30% of the portfolio, then essentially the margins are between 30 to 35%. Blended level, the contribution margin at the center level would be somewhere around 26, 27%. Last quarter, we reported our IGAP EBITDA at about 14.5% roughly. And that will continue to improve as our occupancy improves, because currently the occupancy is at blended of 74%. So as that improves, our EBITDA margins at the IGAP and NDS level both will improve.
Talk to us about beyond FY27. I've asked you the macro level questions. Let me go micro now. Beyond FY27, I'm not going to ask you 26. FY27, what's the kind of growth rate you're penciling in? Because you've seen such sharp growth, likely, at least that's what you're guiding for in FY26. Can you continue to grow on that base? Is there that much demand? You've spoken about the demand environment being strong, but talk to us about whether that will translate to numbers for you.
So hard to make predictions being in a public domain, so I would not go into specifics, but I can certainly tell you that all the green shoots that we started a couple of years ago, today the design and build business for us, which we started 3 years ago, is a 500 crore plus business. In the next couple of years, we will be the largest design and build company in this country. We have started IT under Tech Labs. That was about a 30 crore revenue for us, which again will go 3x at least in the next few years. Similarly for Frame, which is our furniture business, which just started off this year, we will continue to grow that. Also our food and cafeteria management services. Also our alternate seat revenues, which was about 11 to 12% of our revenue this year, which touched about 14%, has the potential to go to up to about 20%. So I think there are a lot of avenues for us to grow. Obviously, co-working managed office, irrespective, is our growth engine. It continues to contribute about 75% of our revenue today. That will continue to grow. But all the other green shoots that I mentioned will contribute significantly. So from a TAM of probably $3 to $4 billion, which is the co-working and the managed office industry, we're now talking about a $12 billion TAM, including design build, Tech Labs, Frame by Awfis, the furniture business, and the F&B cafeteria management.
Okay, Amit, you're clearly non-committal on FY27, so I'm going to wait, take a rain check, and maybe ask you that question again post your Q3 numbers. And I understand where you're coming from. Where managed aggregation versus straight lease is concerned, again, I'll come back to that. Are the return ratios markedly different, or they're broadly the same? And how confident are you of maintaining those kind of return ratios? My understanding comes from the fact that, or rather the question comes from the fact that likely you will be doing a higher investment in straight lease than in managed aggregation. Correct me if I'm wrong, and therefore, ideally your return ratio should be higher in the managed aggregation.
So managed aggregation essentially is a model where the landlord invests majority of the capital, 70 to 80%. After covering the operating expenses, 70% flows to the landlord, the profit, and 30% comes to us. So after what's left on the table, we end up making anywhere between 23 to 24% at a center level, right? But the majority of the capital is from the landlord, and essentially the return on capital employed could be in triple digits, right? Because we are investing a very small amount from our side, and the payback periods could be literally in months. When you do a straight lease, 100% of the risk is being taken by us, where 100% of the investments towards capital is done by us. Also, the rent is fixed. So essentially, your occupancy essentially needs to be 60 to 65% before you start making your first penny, versus in managed aggregation, where you can start making money at about 35 to 40% occupancy. Hence, the return on capital employed in managed aggregation is triple digits. In case of straight lease, it would be between 30 to 35%. So essentially, that's the key difference between the two. And the balance of two is required. As I said, 65% is in managed aggregation, 35% is today in straight lease for us.
Okay. All right. Thank you so much, Amit, for coming in and speaking with us. This has been a good conversation. It's been great perspective, taking the top down and understanding the macro with regard to the sector.
Thank you.
Right. And